How does interest rate parity affect commodity currency exchange rates? Imagine you're watching to countries with economies that relying heavily on exporting commodities like oil, metals, or agricultural products. You might wonder how their currency values change in relation to each other. Well, one key idea to understand is interest rate parity. It's a principle that links the difference in interest rates between two countries to how their exchange rates are expected to move. This concept helps explain why currencies of commodity exporting nations fluctuate in value. Interest rate parity states that the difference in interest rates between two countries influences the forward exchange rate, which is the agreed price to exchange currencies at a future date. If one country has higher interest rates, investors will want to put their money there to earn more returns. But this increased demand for that country's currency should push its value up in the short term. However, the forward exchange rate will adjust to reflected an expected depreciation of that currency over time, balancing out the potential gains. Commodity currencies like the Canadian dollar, Australian dollar, and Norwegian krone are especially sensitive to these changes. When a country raises its interest rates, IRP suggests its currency should appreciate because higher rates attract foreign investment. But at the same time, the forward rate will show an expected decline in that currency's value, balancing out the interest rate advantage. This balancing act influences how commodities priced in major currencies, such as the US dollar, are affected. For example, if the Canadian dollar strengthens due to higher interest rates, commodities priced in US dollars become cheaper in Canadian dollars. This can boost demand for Canadian exports, including commodities. Conversely, if the currency is expected to weaken, the cost of imported commodities rises, which can impact local prices and investment returns. Investors also use IRP to hedge currency risks through forward contracts. These contracts lock in exchange rates for future transactions, helping protect against unexpected currency movements. When interest rate differences are clear, investors can better predict forward rates and plan their trades accordingly. Higher interest rates in commodity exporting countries tend to attract capital inflows, which strengthen the local currency. But this can also make exports less competitive, possibly lowering commodity prices and export volumes. On the other hand, if a country's interest rates fall, its currency might weaken, making its commodities more attractive on the global market. It's important to remember that the uncovered interest rate parity, which doesn't involve forward contracts, suggests that currencies with higher interest rates will depreciate over time. This reflects the risk and expected changes in exchange rates, which commodity investors need to keep in mind when assessing potential returns and currency exposure. In short, interest rate parity helps explain the movements in commodity currency exchange rates by showing how interest rate differences influence both spot and forward rates. These shifts, in turn, impact commodity prices, investment strategies, and the overall flow of capital in commodity markets. Keeping an eye on interest rate policies and exchange rate expectations can help investors make smarter decisions when trading commodities across borders.